Employees arrive at Enron's gleaming downtown Houston headquarters, a building that once symbolized American corporate success. But today, something is different. Security guards are blocking the entrances, news cameras line the streets, and inside, 4,000 people are about to lose their jobs, not because the company is struggling, but because it no longer exists. Just months earlier, Enron was the seventh largest corporation in America. Its stock was worth $90 a share. It was praised by Fortune magazine as America's most innovative company 6 years in a row. But on this morning, that stock is worth 26 cents. Thousands of employees who invested their retirement savings in Enron stock because executives told them it was rock solid have just watched their entire life savings vanish. We're talking about janitors, secretaries, engineers who had worked there for decades. People who had $2 million in their 401k accounts now have nothing. Meanwhile, the top executives, they walked away with hundreds of millions of dollars. This is the story of the Enron scandal, the largest corporate fraud in American history at the time. A true crime documentary about how greed, accounting fraud, and a toxic culture of deception brought down what was once America's golden child. This is the story of how the smartest guys in the room turned out to be the dumbest criminals you've ever seen. And what's terrifying, many of the lessons from Enron remain unlearned. The same tactics, the same greed, the same warning signs keep appearing in our financial system. By the end of this video, you'll understand exactly why Enron failed, how they fooled everyone from Wall Street to Washington, and why this business history matters more today than ever. Let's go back to where it all began. Enron wasn't always a fraud factory. It started as something remarkably boring, a natural gas pipeline company. In 1985, Kenneth Lay, who will become one of our main characters, merged two pipeline companies to create Enron. They transported natural gas through pipes. That's it. Not sexy, not innovative, just pipes and gas. But Ken Lay had bigger dreams. He saw that the energy industry was being deregulated. The government was loosening restrictions on how energy could be bought and sold. And Lay realized something. If energy could be traded like a commodity, like corn or oil or pork bellies, there was massive money to be made. So Enron transformed itself. It went from being a company that owned physical assets, pipes, power plants, to becoming an energy trading company. They created markets where companies could buy and sell energy contracts. And it worked. Brilliantly at first. Here's what Enron did that was genuinely innovative. They created financial instruments that allowed companies to hedge against price volatility in energy markets. Let's say you run an airline. Your biggest cost is fuel. If fuel prices spike, you could go bankrupt. So Enron would sell you a contract guaranteeing fuel at a certain price for the next 5 years. Now you can plan. You have certainty. Where did Enron get that fuel? They'd buy it from producers who wanted to lock in prices too. Enron became the middleman, making money on the spread between what buyers would pay and what sellers would accept. This is called market making, and it's a legitimate business. The stock market works this way. Currency markets work this way. Enron was applying these principles to energy, and Wall Street loved it. Between 1998 and 2000, Enron's stock price quadrupled. Investors couldn't get enough. Here was a company that was transforming energy, a boring, old-school industry, into a high-tech, high-margin trading business. Business schools taught case studies about Enron's innovative business model. Politicians from both parties praised Ken Lay as a visionary. George W. Bush called him Kenny Boy and considered him for Secretary of Energy. Fortune magazine named them America's most innovative company in 1996, 1997, 1998, 1999, 2000, and 2001. 6 years in a row. Enron's headquarters in Houston became a symbol of corporate success. The building was stunning, all glass and steel, with trading floors that looked like NASA mission control. Traders shouted into phones, monitors flashed with real-time data, and millions of dollars changed hands every minute. Ken Lay would give tours to visiting dignitaries, showing off Enron's sophisticated risk management systems and their cutting-edge technology. There was just one problem. Most of it was fake. Looking back, the warning signs were everywhere. But people, investors, Analysts, journalists chose not to see them. First red flag. Nobody could really explain how Enron made money. Their business model was incredibly complex. When analysts asked questions, they got buried in jargon and technical explanations that sounded impressive, but meant nothing. Second red flag. Enron's profits kept growing, but their cash flow didn't. In a healthy company, if you're making more profit, you should have more cash. Enron's cash flow was actually negative in several quarters, even as they reported record profits. How is that possible? Third red flag. Enron's financial statements were incomprehensible. We're talking about footnotes that ran 40-plus pages, filled with references to hundreds of off-balance sheet partnerships with names like Chuko and Jetty, yes, Star Wars references. When one analyst dared to question Enron's numbers on a conference call, Jeff Skilling, the CEO we'll talk about soon, called him an asshole on the recorded line. That should have been a clue. But here's what really happened. Enron's early success wasn't entirely fake. They really did create valuable trading markets. They really were innovative for a few years. But somewhere along the way, the innovation stopped. The real profits stopped. And rather than admit it, rather than say, our growth is slowing, they decided to fake it. They discovered that as long as the stock price kept going up, they could keep borrowing money. As long as Wall Street believed the story, they could keep the game going. And so they made a fatal decision. They would do whatever it took to keep the stock price rising, legal or illegal, ethical or unethical, truth or lies. They would make the numbers say whatever Wall Street wanted to hear. Let's talk about the men who built this house of cards, starting with Kenneth Lay. Ken Lay was not what you'd imagine when you think of a criminal mastermind. He was grandfatherly, soft-spoken, religious. He taught Sunday school. He gave generously to charity. Politicians from both parties loved him. He grew up poor in Missouri, the son of a Baptist preacher. He worked his way through college, got a PhD in economics, and built a successful career in the energy industry. By all accounts, he believed in free markets, hard work, and the American dream. So how did this man become the face of one of the largest corporate frauds in history? Here's the thing about Ken Lay. He wasn't evil. He was weak. He loved being successful. He loved being praised. He loved being Kenny Boy to the president. He loved the private jets, the mansions, the respect. And when his company started to fail, he couldn't face it. He couldn't admit that his empire was crumbling. So instead of confronting reality, he enabled the people around him to lie, cheat, and steal, as long as it kept the illusion alive. Then there's Jeff Skilling, and Skilling is a different animal entirely. Skilling was brilliant. Harvard Business School, McKinsey consultant. He had one of those minds that could see patterns and possibilities others couldn't. When he came to Enron in 1990, he brought ideas that genuinely transformed the company. But Skilling had a philosophy that would ultimately destroy Enron. He believed that the smartest people should be able to do whatever they wanted. He created what he called a loose-tight culture. Loose on rules, tight on results. He didn't care how you achieved your numbers as long as you hit them. He hired the smartest graduates from the best schools and told them, "You're special. You're smarter than everyone else. The normal rules don't apply to you." He instituted a brutal performance review system called Rank and Yank. Every 6 months, employees were ranked. The bottom 15% were fired. Always. Even if everyone was doing well, 15% had to go. This created a culture of cutthroat competition. People would sabotage their colleagues. They'd hide information. They'd take credit for others' work. Anything to avoid being in that bottom 15%. Skilling loved to tell people that Enron had the smartest guys in the room. It became his catchphrase, and he believed it. He genuinely thought that if you were smart enough, you could create value out of thin air. He pushed Enron into bizarre new businesses. Energy trading made sense, but then they started trading weather derivatives, bandwidth futures. They even launched a venture to provide streaming video services. This was 1999, way before the technology was ready. None of these ventures made real money, but Skilling would announce them with great fanfare. The stock would jump, and that's all that mattered. Because here's the dirty secret. Skilling realized that in the short term, perception mattered more than reality. If Wall Street believed Enron was worth $80 billion, then it was worth $80 billion, and at least until someone looked at the actual books. But the real criminal genius was Andrew Fastow, Enron's chief financial officer. Fastow was the one who figured out how to make the accounting fraud actually work, and what he created was diabolically clever. Fastow set up hundreds of special-purpose entities, essentially shell companies, with names like LJM and Raptor and Chuco. These entities existed on paper only. They had no real business, no real assets, no real employees. Here's how the scam worked. Let's say Enron has an asset, a power plant, that's losing money. That's bad for the quarterly earnings report. So Enron sells that power plant to one of Fastow's special entities. Boom. Enron books a profit on the sale. The losing asset disappears from Enron's books. But wait, where did the special entity get the money to buy the power plant? From Enron. Enron would loan money to the special entity, which would use that money to buy Enron's bad assets. See the scam? Enron was essentially selling assets to itself and booking the transactions as profits. It's like paying yourself for your own car and claiming you made money on the sale. And Fastow had another angle. He made himself a general partner in some of these entities. So when Enron did deals with them, Fastow personally made millions. He was on both sides of the transaction, negotiating with himself. But here's what's truly stunning. People inside Enron knew something was wrong. Accountants raised concerns. In-house lawyers questioned the legality of the partnerships. Employees whispered about the accounting games being played. But nobody stopped it. Why? Because everyone was getting rich. Traders were making million-dollar bonuses. Executives were cashing out stock options worth tens of millions. Even mid-level employees were watching their 401k accounts, which were heavily invested in Enron stock, grow by 30%, 40%, 50% per year. Enron's corporate culture celebrated greed. Excess was encouraged. Skilling would take top performers on extreme sports vacations, dirt biking through Baja, trekking in the Australian outback. These weren't team-building exercises. They were celebrations of machismo and risk-taking. The message was clear. We're winners. We're special. The normal rules don't apply to us. And when you believe you're special, when you believe you're smarter than everyone else, it becomes very easy to justify breaking the rules. To understand how Enron's accounting fraud worked, we need to talk about something called mark-to-market accounting. This is where it all started. This is the original sin that made everything else possible. Traditionally, companies record revenue when they actually receive cash. You sell a product, you get paid, you record the revenue. Simple. But Enron got the SEC, the Securities and Exchange Commission, to approve a different method for their energy trading business. They could use mark-to-market accounting, which meant they could record the entire projected profit from a long-term contract the day the contract was signed. Let me give you an example. Say Enron signs a 10-year contract to provide electricity to California. The contract is worth $1 billion over 10 years, and Enron estimates they'll make $100 million in profit over that decade. Under normal accounting, Enron would record that profit gradually, $10 million per year over 10 years, as they actually delivered the electricity and collected the money. Under mark-to-market accounting, Enron could record the entire $100 million profit on day one, before they'd delivered a single kilowatt of power, before they'd received a single dollar of payment. Now, you might ask, what if their estimates are wrong? What if the contract doesn't turn out to be as profitable as they thought? Great question. And here's the answer. They just changed the estimates. Nobody from outside the company could verify these projections. Enron's executives would simply decide what the future value of a contract was, and that became reality on the financial statements. It gets worse. These valuations were based on computer models that Enron created themselves. The models had assumptions built into them, assumptions about future energy prices, about efficiency, about costs, and Enron could adjust those assumptions anytime they wanted. If the quarterly numbers weren't looking good, they'd just tweak the models to show higher future profits. Problem solved. This is like me saying, I'm going to open a lemonade stand next summer, and I estimate it'll make me $10,000, so I'm going to add $10,000 to my bank account today. Absurd, right? But that's essentially what Enron was doing. In 2000 and 2001, California experienced rolling blackouts. Electricity prices spiked by 800%. Hospitals lost power. Traffic lights went dark. The state's economy was thrown into chaos. California's governor blamed deregulation. Energy companies blamed supply shortages and infrastructure problems. But the truth, revealed later, was darker. Enron traders were deliberately manipulating the market. They had strategies with names like Fat Boy, Death Star, and Get Shorty. These involved creating artificial congestion on power lines, moving energy out of California to create shortages, and then selling it back at inflated prices. There are actual recordings of Enron traders laughing about grandmothers not being able to turn on their air conditioning, joking about California burning, celebrating as hospitals scrambled to keep backup generators running. They're taking all the money back from you guys? One trader says on a recorded line referring to California's attempts to control prices. All the money you guys stole from those poor grandmothers in California? Yeah, Grandma Millie, man, another trader responds, laughing. She's the one who couldn't figure out how to vote on the butterfly ballot. This wasn't just accounting fraud, this was economic terrorism. And it was making Enron billions. Meanwhile, CFO Andrew Fastow was creating his masterpiece, a labyrinth of offshore partnerships so complex that even forensic accountants would spend years untangling them. He set up partnerships in the Cayman Islands, tax havens where financial transparency was, let's say, flexible. These partnerships would do deals with Enron, allowing Enron to hide debt and inflate profits. Here's a specific example. Enron built a power plant in Brazil. It was a disaster, way over budget, years behind schedule, never profitable. This was a huge liability on Enron's balance sheet. So Fastow created a partnership called LJM2 that would buy the Brazilian plant from Enron. Enron immediately booked a profit on the sale, and the failing plant disappeared from their books. But here's the kicker. LJM2 was funded partly by Enron itself, and Fastow was running it. So Enron sold the plant to a company that Enron funded, run by Enron's own CFO. Fastow pocketed $30 million from the deal, and Enron showed a profit instead of a loss. It's breathtaking in its audacity, and it was completely legal, or at least nobody stopped them. But surely Enron's auditors would catch this, right? Surely the external accounting firm would blow the whistle. Wrong. Arthur Andersen, one of the big five accounting firms at the time, was Enron's auditor. And they were either complicit or incompetent. Maybe both. Andersen was earning over $50 million per year from Enron, $25 million for auditing, and another $27 million for consulting services. When your client is paying you that much money, you have a powerful incentive not to ask hard questions. Andersen accountants actually worked inside Enron's offices. The lines between auditor and client became completely blurred. Some Andersen employees would literally join Enron's accounting team after working on their audit. It was a revolving door. When questions were raised internally at Andersen about Enron's aggressive accounting, they were dismissed. Partners who expressed concerns were told not to lose the client. And when the scandal finally broke, Andersen did something that would seal their fate. They shredded documents, tons of them. For days, employees fed papers into shredding machines, destroying evidence of what they knew and when they knew it. With all these red flags, how did Wall Street keep recommending Enron stock? How did supposedly sophisticated analysts not see the fraud? Several reasons. First, Enron was incredibly complex, intentionally so. Their financial statements were designed to confuse. When analysts asked questions, they'd get buried in technical jargon. Second, Wall Street had conflicts of interest. The investment banks that employed stock analysts were also doing lucrative business with Enron, helping them raise capital, facilitating mergers, earning huge fees. Banks didn't want their analysts saying negative things about a major client. Third, and most damning, some people on Wall Street probably did know something was wrong, but they didn't care. As long as the stock kept going up, as long as they could sell it to someone else before it crashed, they made money. It's called the greater fool theory. You know something is overvalued, but you buy it anyway, because you think you can sell it to a greater fool before the price collapses. Wall Street was full of greater fools in 2001. August 14, 2001. Jeff Skilling, Enron's CEO, suddenly resigns. The official explanation? Personal reasons. He'd only been CEO for 6 months. He was the architect of Enron's entire business model, and he was just walking away. Wall Street was baffled. Reporters asked questions. But Ken Lay stepped back in as CEO and assured everyone that everything was fine. Enron was strong. The fundamentals were solid. Skilling's resignation didn't make sense to outsiders. But inside Enron, people knew the house of cards was collapsing and Skilling was getting out before it all came down. August 15, 2001. One day after Skilling's resignation, Sharon Watkins, a vice president at Enron, sends an anonymous letter to Ken Lay. The letter is stunning in its directness. I am incredibly nervous that we will implode in a wave of accounting scandals. The spotlight will be on us, the market will not trust us, and we could be the next scandal. Skilling is resigning now for personal reasons, but I think he wasn't having fun, looked down the road and knew this stuff was unfixable. She detailed the offshore partnerships, the accounting tricks, the mark-to-market games. She warned that when this came out, and it would come out, Enron would be destroyed. Lay met with Watkins. He seemed concerned. He promised to investigate. Then, he did nothing. Well, not nothing. He actually asked Enron's law firm whether they could fire Watkins. The lawyer said that firing a whistleblower would look bad, so Lay left her alone but ignored her warnings. Watkins would later testify before Congress and become known as one of the heroes of the Enron story. But in August 2001, she was just another employee watching the company circle the drain. Enron announces third-quarter earnings. On the surface, they look okay. Revenue is up. But buried in the report is a bombshell, a $618 million loss related to those mysterious partnerships. Additionally, Enron is taking a $1.2 billion reduction in shareholder equity. Wall Street finally starts asking serious questions. What are these partnerships? Why is shareholder equity being reduced? What's really going on? Enron's stock starts to fall. Not crash, not yet, but a steady decline that makes investors nervous. October 22, 2001. The Wall Street Journal publishes an article by reporters John Emshwiller and Rebecca Smith. The headline, Enron CFO's partnership had millions in profit. The article reveals that Andrew Fastow personally made over $30 million from the LJM partnerships, the same partnerships doing deals with Enron. The conflicts of interest are stunning. Suddenly everyone is paying attention. The SEC announces it's launching an investigation. Other news outlets pile on. The scrutiny intensifies. October 24, 2001. Enron fires Andrew Fastow. Too little, too late. The stock is in free fall. It's now under $20, down from $90 just months earlier. November 8, 2001. Enron files a document with the SEC that basically says, remember all those financial statements we filed for the past 5 years? Yeah, those were wrong. We need to restate our earnings. They're admitting that they've been lying on their official financial reports. They've been defrauding investors. The stock collapses. It's now under $10. Enron has one last hope. Dynegy, a smaller energy company, offers to buy Enron for $8 billion. It's a rescue deal. For a few days, there's hope. Maybe Enron can be saved. Maybe thousands of jobs won't be lost. But then Dynegy's executives start looking at Enron's actual books. Not the public financial statements, the real books. And what they find terrifies them. The debt is worse than anyone knew. Way worse. Enron owes billions more than they've disclosed. The offshore partnerships are even more complicated and fraudulent than suspected. This isn't a company with problems. This is a company that's already dead. It just hasn't fallen over yet. November 28, 2001. Dynegy pulls out of the deal. Enron's stock drops to 1. The credit rating agencies, who should have spotted this years ago, finally downgrade Enron's debt to junk status. December 2, 2001. Enron files for Chapter 11 bankruptcy protection. At the time, it's the largest corporate bankruptcy in American history. $63 billion in assets gone. Thousands of employees jobless. Investors who held Enron stock wiped out. The scenes from downtown Houston are apocalyptic. Employees walk out carrying boxes of their belongings. News cameras capture their shocked faces. Some are crying. Many are angry. Retirement savings accounts, 401ks heavily invested in Enron stock because executives encouraged it, are now worthless. We're talking about longtime employees who had $1 million, $2 million saved up. People who were planning to retire in a few years. Now they have nothing. One employee, Charles Prestwood, had worked at Enron for 33 years. His 401k was worth $1.3 million and entirely in Enron stock. Meanwhile, in the years before the collapse, Kenneth Lay sold $300 million in Enron stock. Jeff Skilling sold $200 million. Andrew Fastow made over $45 million from the partnerships. They knew. They got out. They left everyone else holding the bag. The criminal trials took years, but eventually justice, at least partially, was served. Andrew Fastow pleaded guilty to conspiracy and was sentenced to 6 years in federal prison. He served 5 years and was released in 2011. Jeff Skilling was convicted on 19 counts of conspiracy, fraud, and insider trading. He was sentenced to 24 years in prison. After appeals, that was reduced to 14 years. He was released in 2019. Kenneth Lay was convicted on 10 counts of fraud and conspiracy. But here's where it gets strange. Before he could be sentenced, he died of a heart attack. Because he died before his appeals were exhausted, his conviction was vacated. Legally, Kenneth Lay died an innocent man. His death meant that prosecutors couldn't seize his assets. His wife, Linda Lay, got to keep much of their wealth, including a $4 million home in Houston. Arthur Andersen, the accounting firm that enabled all of this, was destroyed even faster than Enron. They were indicted for obstruction of justice for shredding documents. In 2002, they were convicted. The conviction was later overturned by the Supreme Court, but it didn't matter. The damage was done. Andersen, one of the world's most respected accounting firms, went from 85,000 employees worldwide to essentially zero. Clients fled, employees jumped ship. The firm dissolved. It was the only one of the Big Five accounting firms to completely disappear. Now we have the Big Four. Congress moved quickly. In 2002, they passed the Sarbanes-Oxley Act, the most significant reform of corporate governance and accounting in decades. Sarbanes-Oxley, or SOX as it's called, did several things. CEOs and CFOs must personally certify their financial statements. If the numbers are wrong, they can go to jail. Companies must establish independent audit committees. Auditors can't provide consulting services to the same clients they audit, closing the conflict of interest that destroyed Arthur Andersen. Penalties for fraud were dramatically increased. Was it enough? We'll get to that. But let's not lose sight of the real victims here, the employees. Over 20,000 people lost their jobs when Enron collapsed. Many lost their life savings. Families were destroyed. People who had worked honestly for decades were ruined through no fault of their own. There's Charles Prestwood, who we mentioned, 33 years at the company, $1.3 million in retirement savings reduced to $13,000. There's Janice Farmer, a secretary who had $700,000 saved. After the collapse, $15,000. These weren't wealthy executives. They were working-class people who believed what management told them. Enron stock is safe. Invest your retirement here. Meanwhile, 29 Enron executives and traders walked away with over $1 billion in the years before the collapse. Even after fines and restitution, most of them kept a substantial amount of their wealth. So what actually caused Enron to fail? If we had to distill it down to the core issues, first, a culture that valued short-term stock price over long-term value creation. Everything at Enron was about the next quarter's earnings, the next analyst call, the next stock price target. Nobody was asking, are we building a sustainable business? Second, complexity used as camouflage. Enron deliberately made their business model incomprehensible. The more complex the financials, the harder it was for outsiders to see the fraud. Third, conflicts of interest everywhere. Auditors who were also consultants, executives who profited personally from corporate deals, board members who were paid too much to ask hard questions, analysts whose banks did business with Enron. Fourth, a belief that the rules didn't apply to them. The smartest guys in the room, the most innovative company in America. They genuinely believed they were special, that normal ethical and legal standards didn't apply. Fifth, a complete failure of gatekeepers. Auditors didn't audit. Rating agencies didn't downgrade. Regulators didn't regulate. Journalists didn't investigate until too late. Board members didn't oversee. Every institution that was supposed to protect investors and employees failed. Here's the uncomfortable question. Has anything really changed? Yes, we have Sarbanes-Oxley. Yes, some people went to jail. But have we fixed the fundamental problems? In 2008, just 7 years after Enron, we had the financial crisis. Banks had created complex mortgage-backed securities that nobody understood. Rating agencies gave them AAA ratings. Auditors signed off. Regulators missed it. And millions of people lost their homes and savings when it all collapsed. Sound familiar? The same patterns keep repeating. Complexity, conflicts of interest, short-term thinking, and a belief by those at the top that they're too smart to fail. We've seen it with Theranos, a healthcare fraud built on lies and enabled by starstruck investors and compliant board members. We've seen it with FTX, a crypto exchange that turned out to be a house of cards, with customer funds misused and accounting that would have made Andrew Fastow proud. The tactics change, the technology changes, but the fundamental dynamic, greed, deception, and the failure of oversight, remains the same. The Enron scandal taught us something important if we're willing to learn it. When something seems too good to be true, it probably is. When a company's business model is too complex to understand, be skeptical. When executives won't answer direct questions, that's a red flag. When everyone is making money so nobody wants to ask questions, that's when you should ask questions the loudest. The smartest guys in the room at Enron weren't smart at all. They were arrogant. They believed their own hype, and they confused financial engineering with real value creation. Today, Enron is synonymous with corporate fraud. It's the cautionary tale we tell about greed and corruption. But here's what keeps me up at night. Somewhere right now, at some company you've probably heard of, someone is making the same decisions Enron's executives made. They're fudging the numbers just a little. They're creating complexity to hide problems. They're prioritizing stock price over ethics. They're believing they're too smart to get caught. And just like with Enron, everyone around them is staying quiet. Because they're making money. Because they don't want to lose their jobs. Because it's easier to look the other way. Enron collapsed over 20 years ago, but the lessons remain urgent. The warning signs remain relevant. And the question remains, are we paying attention? The Enron scandal was not just about accounting fraud or stock market manipulation or corporate greed, though it was all of those things. It was about what happens when we stop asking questions, when we trust the wrong people, when we confuse complexity with sophistication and confidence with competence. The employees who lost everything at Enron weren't foolish. They were trusting. They believed in their company. They believed in their leadership. And that trust was betrayed in the most profound way possible. If this documentary has taught you anything, I hope it's this. Stay skeptical. Ask questions. Demand transparency. And when something doesn't make sense, don't assume you're not smart enough to understand it. Consider that maybe, just maybe, it doesn't make sense because it's not supposed to make sense. The smartest guys in the room turned out to be the biggest frauds in business history. Don't let it happen again. Thanks for watching this deep dive into the Enron scandal. If you found this valuable, hit that like button and subscribe for more documentaries about business history, corporate scandals, and the economic events that shaped our world. Drop a comment below. Were you affected by the Enron collapse? Did you know someone who worked there? Or are you seeing similar warning signs at companies today? I want to hear your thoughts. And if you want to learn more about this story, I highly recommend the documentary Enron, The Smartest Guys in the Room, and the book it's based on by Bethany McLean and Peter Elkind. It's investigative journalism at its finest. Until next time, stay curious, stay skeptical, and never stop asking questions.